So this video shows how to create a balance sheet and cash flow model within Anaplan. So first of all, we start with our lists or organization, which is normally as our companies. Um, we'll look at the balance sheet account structure, so that's loaded in to replicate your chart of accounts in the balance sheet. There's a list to allow journal entries to be uploaded should you need to do that for consolidation purposes. And then these two profile percentages and debtor creditor days are two lists that will be used together later on to allow you to very cleverly phase cash payments. So the combination of these two lists will allow you to enter different debtor and creditor profile days, such as 50% in the same period, 50% next, and then apply those to each line in the chart of accounts. And using this profile percentage, which basically lists out the periods, the months to come, will then automatically calculate the cash payments of each line on the chart of accounts using a command called profile in Anaplan, which is a very powerful command for doing phasing. So we've got our lists. Then we have a special thing called line item subsets, which are basically, for example, if I want to group certain chart of account values into certain categories, so if this one is purchases, or asset purchase and funding, I have a list of all the chart of accounts and I can just set the flags to say these are all relevant to assets and funding accounts. These ones are relevant to receipts and payments, so most will be turned on. Some of them that are non-cash, like depreciation and stuff like that, will be switched off. There's an example on gain on disposal of assets as an accounting entry rather than a cash entry. Similarly for VAT, I can apply VAT groupings, and then for cash flow accounts. So this is me saying, oh, okay, of all of these items, these are the ones that I want to appear in the cash flow module, and a similar list for P&L items to say these are a sub dimension to allow me to build just P&L related modules. So these are effectively dimensions created on the fly from lists that already exist. Okay, so those are our main lists. Then our modules. Okay, so the trick with the modules here in terms of mapping the data to the right place is to create three mapping tables here. The first one maps each line to a current asset category. So if I open the module, you'll see I've got all the P&L here listed here and balance sheet, and then it says, okay, map me to trade debtors, accrued income, etc., and those are all drop-down list formatted items that say, okay, this is where I want to map this to. I can then say, is it a cash account? Yes. What type of cash account is it? Then what are the debtor creditor terms as per the list I showed you back here, which is this one. Which of these items applies to this line of the chart of accounts? Is there a VAT amount? What is it? And whether the VAT is due at the time of payment or on an accruals basis, and to which VAT account does this line map to. So that's mapping all the P&L and balance sheet to the current assets module. That's the first one. Then we have, excuse me, mapping of to fixed assets and funding. So similarly, okay, I now want to map these particular items, and if I look at the dimensionality, you'll see that I'm using, you can't quite see it here, but that is the list the list I created at the start called, I'll just show you here. It's the line item subset called this one, asset purchase. So it's using this specific list filtered for all of these items that have got a checkbox on them, and it's using that list as a dimension over here. That's what this is doing here. This is that list filtered just for those items. So it lets you very tidily map to each of the relevant accounts to which part of the fixed assets or balance sheet lines that those relate to. And then the last one is to map the cash flow items, which is this one. So this is now mapping the balance sheet to the cash flow. So again, if I look at the behind the scenes, what dimensions it's using the balance sheet accounts, and it's saying, okay, for each one of those, which cash flow account is relevant for each of these lines. So this will be the cash flow account you'll see in the cash flow module later, and it's saying, okay, map all of these to the correct area in the cash flow module. So those are the three key mapping mappings that need to be done at the beginning once you have your full chart of account structure loaded in. The timings then is this is the module I was explaining earlier, where it calculates payment profiles of any line, chart of account line. So basically, this is where you're telling the module, what does 30 days mean? It means 100% of the amount should hit the cash flow in the next period. And also, for example, so 60% same period. So give me 60% of the amount to the cash flow this month, and then 40% in the next month. This is a very clever, simple grid that then gets used in a function called profile, which I'll show you shortly, to work out what the cash flow amounts are, and saves you an awful lot of time in figuring out what cash flow should look like. So that's the timings module. This, I think, is just the P&L that's being used, yeah, which can be loaded in or calculated from underlying modules that you would use to build a P&L. Loans and financing is just specifically looking at the loans and financing piece to say, okay, what dimensions am I using? I'm using the line items, these line items, and just the overall organization. So just specifically for loans and financing extract. The similar one for inventory, fixed assets, loading in the actual balance sheet. Journals, if I need to post them, I would do it here, and I do the debit and credit here, and these lists are all pre-formatted, so you can only choose correct line items. You can't put in your own. So that allows you to create journals on the fly if you need to. And then this is probably where the heavy lifting is done, is this module, receipts and payments. So if I look at the dimensionality, I'm using receipts and payments line item subset, which, to remind you, was created at the beginning over here. Receipts. Okay, so this is where I've gone in and I've said, okay, show me the entire P&L and balance sheet and flag up those items that should appear in the receipts and payments module here. Okay, so by using this by using this line item subset here, I'm literally filtering out just the accounts that I want to show on the receipts and payments module over here. So it's a nice way of creating a dimension on the fly. And by doing that, it allows you to use this collect function. So collect basically says, I'm going to look at this line item subset that you have here, this one, receipts and payments line item subset, and I'm going to go and refer to it and sum up all those items that relate to whatever you've got in this list here. So it's a nice quick way to aggregate. So then what it's doing, the real guts of this one says, right, I've told you, or you've told me earlier that gross sales has a 65-35 day payment profile. So what it'll do then is it'll say, okay, what's the amount in the month? 10,000. I'm going to split that 10,000 for cash flow purposes, 65% this month and 35% into the following period, which is governed by this module timings. I showed you modules timings. So this is what 65-35 means. 65% this month, 35% the next month. That's what this module is using to calculate the 7,800 here and the piece that will fall in here. So 65% of that 10,000 appears in January, and the other 35% is automatically calculated and dumped into February, and that applies. That logic applies to each value in the month. So this cash flow is calculating 65-35 all the way through. And that's linked to that gross sales. If I change it to something else, let's say I change it to what might be good, rents and rates, not a good one. That seems to be okay. Let's just see if there's anything else that has a specific. Okay, so this one has a different one called timing spread over 5 periods, I think it is. So if I go back to the timings, you'll see what that means. Spread over 5 periods starting next means spread me 10, 20, 40. You can adjust this profile to whatever suits, whatever is applicable. So that one we're looking at here, which is telecoms, has been spread over 5 periods using this logic here. Okay, so you can see how powerful that is in terms of quickly calculating accurate cash flows. And that's what this module is doing for all of those items that have been marked as relevant for receipts and payments. So it's pretty flexible way very fast way of doing a cash forecast. So once you've done the receipts and payments, very similar idea for the assets and funding. It's using the same idea here. And when that is all, sorry, that's the summary at the end. This is where the VAT calculations are being done. So again, the VAT calculations are looking at sorry, bear with me. They're reading across to the receipts and payments for those items that have VAT relevant to them. And then here's where you would manually input the VAT payment or receipt amount, cash flow amount. And then this is the P&L adjusted for the journal entries. So you can see here there's a calculation saying take the original plus the journal offset and so on. So this is allowing you to do journal entries at the P&L level and balance sheet also. And then the balance sheet finally will look like, so what this is doing is taking the net movement. So there's a calculation, I'll show you here, the net movement on the balance sheet. Oops, sorry, not that one, this one. Okay, it's working out, am I an actual period? Yes, then use my closing balance, and if not, then pull me in from receipts and movement on receipts and payments, movement from the cash amount, and movement on assets and funding. So go and find me all those amounts and bring them in. And those amounts are all coming from other parts of the model, which say, okay, this value, go to the receipts and payments module, pick me up the forecast cash payments and sum it up on that relevant cash account, which is this. So this is bringing in all the movements. So if I just rearrange this for 1 sec, you'll see better what's happening here. If I pull this to here and swap them, you'll now see that for fixed, let's choose something with a bit more movement in it, probably this one, trade debtors, here's a good example. Okay, so this is saying, okay, go and find me the movements calculation in the receipts and payments module, and sum it up on this, sum it up on trade debtors, using the mapping that I created earlier. Pull this in, and that's giving me my movements from the receipts. Do the same thing for the cash. Go to the cash module, pick up anything that's relevant for cash, any of the journals that were put in. Okay, and that gives me my total net movement. I know what my closing balance was before, and the formula then says, right, take the previous and add, sorry, it's this one also. Net movement plus the previous. So previous is a nice command where it always knows. Previous means last period, take the value of last period and add to that. So that's calculating all my balance sheet movements for trade debtors. And the same logic, and the single formula applies to everything else. So these formula here apply to everything. So that's why the mappings were so important earlier. And that creates the balance sheet. And then the cash flow really is picking up all the net cash, the relevant cash movements from the balance sheet. So you'll see here, pick me up balance sheet net movement, but specifically the cash flow account. Same with the P&L journals in case any of those are relevant for cash, and brings them all through. So those are all connected modules pulling in all of the net cash movements from P&L, from the balance sheet accounts, debtors, creditors, etc., loans, financing, everything else, using the same formulas. For each line item has its own specific formula, but that formula applies everywhere throughout this line, no matter what period you would look at or what company you would look at for that matter. So the only thing I can't show in this one is consolidation. There's another module that would need to be built on top of this to say, right, these are the consolidation adjustments, and to then feed those through into the final balance sheet. So I think that is a quick explainer of how you would build a balance sheet and cash flow model from a P&L in Anaplan. Hope you found that useful. Oops, sorry.